good stuff, and it's one of my favourites. But Andrew, we're talking to everybody about
Bring it back on track.
money rules that no longer work in 2025. So I guess it's a good lead in that there's certain rules of thumb, if you like.
Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics such as investing, cash flow, budgeting, saving, passive income, debt management, and much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host.
Andrew, Bills, here we are back again and sponsored again by Tommy Hilfiger.
Yes.
Yeah, we definitely need to get a sponsorship from them because I think that's the second time that we've both worn the exact same jumper and we're not getting paid.
Well, you know what? I listen to a lot of podcasts and stuff, a wide range of content, and I swear there's sponsorship, like that's how people monetize it, right? Like, mate, look at this, Tommy Hilfiger, what are you doing?
Yeah.
Come on, hit us up. We're raring and willing to go. We've got 2 consistent viewers and listeners, being both of our mums.
Yeah, exactly.
Like, you know, that's a good start.
Yeah, exactly. All of our Christmas presents are going to be Tommy Hilfiger if you sponsor.
They do have some good stuff, and it's one of my favourites. But Andrew, we're talking to everybody about
Bring it back on track.
money rules that no longer work in 2025. So I guess it's a good lead in that there's certain rules of thumb, if you like, that tend to be out there. We're going to try and demystify and debunk a few of those and basically say, okay, these no longer work in 2025.
Yeah, and look, these are, some things that back in the day might have been relevant and might have, worked. And so for people as old as Billy, you probably still think that, they work. But
back in my day...
But look, things have obviously moved, economies have changed, and hence your rules of thumb and things that, might have worked back in the day are no longer as relevant. And so hopefully we can bring this into, the modern world of 2025.
That's it. All right. So we've got a few to cover. So we're going to go short, sharp with these and just firepower through them. So the first one, Andrew, the 10% savings rule. So basically what this is saying, okay, in order to have a really healthy savings rate, whatever your income is, take 10% off the top. We always talk about the principle of paying yourself first. Grab that money, put it aside. That process is still sound. Don't get me wrong. What are we talking about here? It's just a percentage of 10%. We're basically saying that no longer works in 2025.
Yeah, I don't think 10% is enough, to be honest with you. And truth be told, you're provided that you're an employee rather than self-employed, that 10% is already taken care of for a lot of people in the form of superannuation. It's now it's at 12%, but really, I think above and beyond that, if you just put money into superannuation and you do nothing else, I don't think that that's going to be sufficient enough to be able to live the same lifestyle that you have in retirement. So really, the thing that we look at is if you can save, 20 to 30%, that would be a much more sustainable number. Automate it, don't think about it. Percentage based, so that if income goes up, so do your contributions and all of that stuff, and maybe you adjust it based off what your life stage is. If someone's taken time off work for maternity leave, for argument's sake, you might need to adjust it because your mortgage repayments aren't going to drop or anything over that period of time. But 10% isn't enough.
Yeah. Yep. No, well said. Rent money is dead money. Renting is wasting money.
I love this one.
Well, you can talk about it then. But so that used to be the case. I guess barriers to entry are a lot higher in terms of getting into property now. But let's dig into that one, Andrew. What's the go with that? That renting is no longer wasted money.
Yeah. Look, there's a million different ways to be able to structure your finances. And the old adage was, why would I pay off someone else's mortgage? Which is another way of saying the exact same thing in this. But it's unfortunately, that's just not the case. Mm-hmm. yes, purchasing a property gives you some benefits. Purchasing an owner-occupied property rather than, let's say, an investment property and not renting has some benefits associated with it. There's capital growth. So if you sell that property, you don't pay any tax on that capital growth. It's a forced savings mechanism because you're making mortgage repayments. But there's also some downfalls to it. You consider your mortgage repayments. They're, depending on what type of mortgage and depending on, what your loan balance is, you could be spending, $4,000 or $5,000 a month pretty easily on mortgage repayments, where a similar property might be costing you in the form of rent, maybe $3,000 a month. So if you can rent and use that additional surplus to invest, whether that's in another property, an investment property in rentvest, or whether that's putting that into, an index fund, or whether that's putting that into any other form of investment, renting is not dead money, but renting and not investing is dead money.
Yeah.
So provided that there's a strategy, provided that you're doing something else with the money, it's not as simple as buy your house, pay off your house, and a government pension's going to take you for the rest of your life. So renting is not dead money.
Yeah, and just pointing out with that too, it's not necessarily, if you think about, let's use some round numbers, your mortgage is $5,000 and your rent per month is $3,000 or $3,500. We're not just saying take the $1,500 difference and invest it. If you think about a property, all of the other expenses that you incur that you wouldn't incur if you were renting, and it could be something as simple as I went to Bunnings on the weekend to, whatever it may be, to do some improvements to the property. Like, that amount of money there should go across. Yeah. So it's not necessarily just the difference, because it's amazing how much money that is when you factor that in over a complete year, and then you compound that over a lifetime. Essentially, it's quite huge. Yeah. So, yeah.
And in addition to that, on the flip side, just to play devil's advocate, like, I've also had conversations with people whereby the discussion is, I can rent the same property for $2,000 a month and my mortgage repayments would be $3,500 a month, so I'm better off renting. Well, no, because if you buy the property and you make P&I repayments, in 30 years you own an asset that's worth X million dollars, versus if you rent that same property and do nothing else, you've got nothing. So understand what you're doing and why you're doing it and make a rational decision. And for some people, rentvesting works, and for other people, buying an owner-occupied property and still building wealth outside of that works. You just need to work out what's right for you. But it's never a strategy of, you'd never rent.
And factor in the cost of the debt.
Yeah, exactly.
Yep. Andrew, what do we got next?
Emergency fund should cover 3 months of expenses.
Yeah, look, I really like this one because obviously we've got, some rules of thumb that we tend to use in terms of, this is how much you should have sitting there. If you take 3 months and you think about that, and then you overlay it with where we're at from an economic perspective at this point in time, things just move a lot more. And especially in this day and age, back in my day, especially back in this day and age where you think about something like, say, AI and how quickly we can be disrupted, 3 months, in my mind, is no longer long enough. It needs to be longer. Yeah. It definitely needs to be longer because, you may think, back in the day, you'd have a job for life. That's not the case, and we're seeing that people are changing careers more and more often. And when you look at the data that's coming out, the expectation is, say, our kids, they're going to have multiple careers throughout their working years. Yeah. And it just changes a lot more rapidly. And I don't think 3 months is enough there to give you the level of certainty that it's designed to do, like it did previously. So the old adage about having an emergency fund still rings true, but all we're saying is that at the 3 month mark, it's no longer enough to be able to compensate for what we've got in today's, world that we've got, because we're filled with more uncertainty at this point in time than we have previously in the past.
Yeah, 6 to 12 months is much more of a realistic number, and you adapt that based on your circumstances. Do you have kids? Do you have any other source of income that's passive that'll come in? How big is the mortgage versus all of the other expenses? But yeah, 100% agree.
Andrew, paying off debt before investing.
Yeah. I think that really there was in in an environment where interest rate or the rate at which you can have your debt versus the rate of growth that you can get, paying off all of your debt before you do any form of investing, mathematically, it just doesn't ring true. And for some people, that's the right strategy, right? And so I don't want to sit here and say, no, that's not right. You should never pay off your mortgage and then invest. But when you consider, okay, well, let's use property as an example, because property is really a simple one that most people can understand. If you wait until you pay off your owner-occupied debt before you ever even consider investing, you could be bending on your payment rate, 10, 20, 25, 30 years until you actually pay off that mortgage. Versus, and then you go to purchase an investment property.
You're losing decades.
And you've lost decades worth of growth. Versus, provided that obviously it, fits within your budget, provided that you're not taking on a, exorbitant amount of risk, provided that you're doing things, in the correct manner. Maybe bringing your debt down to a more sustainable level, adding an investment property into the mix, in year 5, and having, 2 properties where you've got 30 years worth of growth rather than just one, can be a more sustainable solution. Maybe considering things like a debt recycling strategy whereby, you can pay down debt and invest and do that all at the same time. There are other options, and simply paying off all of your debt before you do any form of investing, unless your risk tolerance is extremely conservative, usually not the best way to go.
Yep. No, well said. One of the ones from my perspective, spending less in retirement. I don't know about the people that you talk to, Andrew, or the idea that you've got about what your retirement looks like, but I don't necessarily think that's the case where, you go at the end of your working career and basically you put your feet up and you relax, you watch TV and you don't do anything. That's not the case. People are doing a lot more. Travel in particular. I feel like we've got more vitality for longer these days. There's a greater level of financial support that we are giving adult children. So that then changes that metric as well too. And obviously in terms of the cost of everything, especially healthcare, everything's getting more and more expensive. So where you turn around traditionally and say, okay, this is what you were spending when you were earning, this is where it was at, and now all of a sudden you've retired and it's going to be down here somewhere. Actually, in my experience with people that I talk to, it goes the other way, at least for a period of time, because there's really a few things. Not only have you got time to spend more money, but you've also got on your, I guess, call it your bucket list, things that you want to try and tick off that you haven't had the time or the money to do back in the day when you were working. And a lot of those things are, let's travel. Yeah. That's a huge one. It could be upgrading. It could be upgrading a car. It could be doing those renovations to home. So I actually see that expenditure goes up at least immediately for those things, but over time it's increased, and then over time it starts to come down as people tend to slow down. But spending less in retirement, I don't think that rings true and is no longer the case in 2025.
Yeah, absolutely. And I think that's has something to do with how much more mobile people are at the stage of retirement. Mm-hmm. So historically, where maybe life expectancy wasn't quite as long as what it is now, people would retire and they would, maybe not have as much energy and travel would be more difficult. Whereas, 100% agree, in almost all of my experience, at least in the early years of your retirement, your income need is significantly higher. And so, because you're traveling, because you're doing those things that you don't necessarily have time to do. And so I think within that, one, there's the expectation around the level of income that you need, but also there's the discussion piece around where your assets sit. So if you, let's say, just own property and all of your income is in rental income, well, your income level is very fixed. You don't have the ability to dial it up and dial it down depending on your life stage. So I think that in the lead up, considering things like superannuation and all of that stuff is really important in developing the strategy.
Andrew, from a car perspective, this is an interesting one because we're probably at the most interesting point in time when it comes to cars. What do we think that's no longer relevant in 2025 about cars that used to be relevant?
Cars are a really interesting one, and we get this question all of the time. And so I can't tell you that there's the right solution, because you need to do the numbers around your own circumstances. But old adage was, you buy a car, you pay it in cash, and that's it. You never buy a car unless you're paying for it in cash. You don't lease it, you don't have finance, you don't do anything other than paying for it in cash. And in principle, it's sound. You don't pay interest on a car, it's a depreciating asset. You don't pay interest on a depreciating asset. But there is a but.
There's always a but.
When you consider the cost of a car these days, and you consider the opportunity cost of what you could have done with that money, you also look at it and say, well, am I ever actually going to buy a car if all I'm going to do is ever pay for it in cash? And I'll use a, Toyota RAV4, again, another sponsorship, but you're talking about...
They're not cheap.
Yeah, well, that's what I'm saying.
They're expensive these days. We had a look at one.
Well, that's... I'm about to go on a rant here. Not necessarily a rant, but just where things are at. Like a RAV4, back in the day, was your,
25 grand.
Normal, average, everyday person car. We'll drive that to the ground and, will last forever. There you go, plug for Toyota there. But a Toyota RAV4 costs 60 grand these days.
Yeah.
Like, you're talking about a significant amount of money, and for a lot of people, it's not possible. Or if it is possible, what is going to forego on the flip side? So if you're going to buy a car in cash, are you going to delay an investment property purchase, which could have, significantly more capital growth? So not necessarily writing off, if you can afford to buy a car in cash, fantastic, avoid the interest, that's great. But are you self-employed? Do you have, opportunity to be able to use that as a work vehicle and claim some of the tax back in the form of, interest and depreciation? Is there another way to structure it that's going to be right for you and give you more opportunities in the future, rather than just, tunnel vision view of, that's it, you only ever buy a car in cash?
The other thing too, and I heard this on a podcast yesterday, it's something that I'd given thought about ages ago, but this person was essentially a financial commentator overseas, but she was saying that she doesn't own a vehicle because of the cost. She did the maths, and you think about things like ride sharing with Uber and Didi and a couple of other sponsors that are going to jump on board too. If you think about the cost associated with that, she actually worked out that it was cheaper to do that, and more convenient to be able to do that rather than purchase a car.
Yeah.
And then you think about things like self-driving, and that just completely changes the dynamic altogether. But yeah, that's definitely something to look at, and more creative. Plus, if you extend that thinking out, just interesting by the by, back in the day, if you look at a household, the average number of cars that a household used to have, it used to be one and the whole family used to share it.
Yeah.
Now the expectation is that everybody who's over 18 has their own vehicle.
Yeah.
So it's changed quite dramatically in such a short period of time. So maybe there's something in that. Maybe we've gotten too used to having the convenience, the keys available any particular time that we want, as opposed to just, doing it when there's a car available.
Yeah, exactly. And before we wrap up the episode, because I am someone that always longs for a time that's now gone, I'm gonna throw something in there and finish it off with an old adage that absolutely rings true today, because I don't want to just hate on the past, and that's spend less than you earn. That is just as true today as what it was 50 years ago. It's the number one principle in finance. We add a little spin to it and say, spend less than you earn and invest the surplus. Yeah. But they definitely got that one right. So
So that's the opposite of what we're telling everybody today. That's the one that has stood the test of time.
Stood the test of time.
It's got to be a Warren Buffett quote in here somewhere, Andrew. To our listeners and our viewers, thank you for today. If there's anything in there that resonated and you want to have a chat, feel free to reach out. As always, details are in the show notes. Andrew, thank you for today.
Thanks very much, Bills, and thanks for everyone for tuning in. Look forward to catching you on the next one.
Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au. The information in this podcast is general in nature and does not take into account your personal objectives, financial situation, or needs. It is not financial, legal, or tax advice and should not be relied upon as such. You should consider whether the information is appropriate to your circumstances and seek professional advice before acting on any of the information provided. Past performance is not a reliable indicator of future performance. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of Acumen Financial Planning Proprietary Limited.